Walmart has an asset utilization ratio of 2.3, whereas if you look at Ford, its asset utilization ratio is 0.5. Why is it so different? Is Ford doing poor in terms of utilizing its assets? And if yes, why is it so? Or is it sector dependent? The actual answer lies in understanding what operating efficiency ratios are like. Think of asset turnover ratios, fixed asset turnover ratios, and equity turnover ratios. And this is what our video is all about today. Hi all, my name is Dheeraj Vaidya from wallstreetmojo.com, the home to most authentic place to learn finance and accounting. Without wasting much of your time, let's get started. What is asset turnover ratio? Asset turnover ratio is a part of the ratio analysis framework and it comes under the operating efficiencies. It basically helps us in understanding how much amount of sales a company is able to generate from its assets. So another way to look at it is that how effectively whether the company is able to utilize its assets to generate sales or not. So if the company is not doing justice and not able to utilize its assets, this asset turnover ratio will be low. However, if the company is doing an exceptional work in utilizing its assets, their ratio will be higher. What it essentially gives in simple terms is how much amount of sales are you able to generate from your assets on a per unit term. So let's look at the formula and things will become a bit clearer from there. So here is the formula of asset turnover ratio. So if you look at the formula, its numerator has net sales and in the denominator has average total assets. It's very simple formula to actually look at, but you need to understand what net sales means and how you can take it from the income statement. Net sales, it essentially means that it is not equal to gross sales. First thing, gross sales is what the top line number of the income statement is all about. So after you deduct all the refunds or let's say returns or the discounts, that's when you get your net sales numbers. Okay. If the company has reported both your gross sales numbers and net sales numbers, you basically take the net sales numbers here. All right. The second term that's important here is the average total assets. So average total assets is nothing but the average of the total assets from the start of the year and the end of the year. Why do you take the average? Because the total asset number is a balance sheet item. As we have seen in other ratios as well, if an item is a balance sheet item, you usually take it as a average because you don't want to skew your calculations by taking just a single snapshot at a single point in time. Taking an average, smoothens this process of calculating the ratio. This is because, the total assets may change during the year a lot, and it might actually, lead to calculations which are out of proportions. So that's why we should always take average when it comes to balance sheet items. Like in this case, it's the total assets. Now, second thing you need to remember here is that when we talk about total assets, it's all kinds of assets like the property, plant, and equipment, that's the fixed assets. Then think of the intangible assets that you cannot touch, feel, something like copyright. Assets would be also include, goodwill as well. There could be cash equivalents, account receivables, inventory. All of this is a part of the total assets. So total assets is equal to current assets and the other part of long-term assets which are given there on the balance sheet. So you should take all that as well. Okay, so this is how you calculate the asset turnover ratio. So let us now take an example to understand the asset turnover ratio calculation and its interpretations. So here we have this data of two companies, company A and company B, and we have been provided with the gross sales data and the sales discount, as well as the assets at the beginning and the assets at the end. So these two are the balance sheet items, and gross sales and sales discounts are essentially the income statement items. So this has been provided to us, and we are expected to calculate the asset turnover ratio and see which company is performing better in terms of this ratio as such. So, what's the formula for asset turnover ratio? The formula is net sales divided by average assets. Okay, so this net sales divided by average assets. All right. So the first step will involve calculation of net sales. So what is the net sales? As we discussed earlier, net sales is gross sales minus the sales discount. So here for company A, it will be 10,000 minus 500. So that comes out to be 9,500 as net sales of company A, right? Likewise, for company B, this will be 7,800 because 8,000 is the gross sales and 200 is the sales discount. Okay, so this is the net sales numbers. The next step is to calculate the average assets, right? So the average assets is the average of the assets at the beginning and the end of the year. So this is, you can use the word, the formula average to calculate the average of the assets. That is 3,000 and 5,000. The average will be 4,000. And for company B, the average assets will be 5,000 here because 4,000 and 6,000, when we add this, it becomes 10,000 divided by 2. It's 5,000. All right. So what is the asset turnover ratio? The asset turnover ratio is 9,500. That is net sales divided by your average assets. Okay. So this comes out to be 2.375. And for company B, it comes out to be 1.56. So as you can see, company A is doing better in terms of asset turnover ratio. And if both of these companies are in the same industry, we could have interpreted that company A is actually doing much, much better because they are able to generate sales of $2.375 per unit of their per dollar of their assets. So that's how the interpretation is, right? So between these two, if they're in the same industry, of course, company A is doing much, much better. Now, the next question which I have right now is that how about if the asset turnover ratio, if it is less than 1, whether it is good or bad? And when the asset turnover ratio is greater than 1, is it good or bad? So, of course, the asset turnover ratio, if you look at the absolute number, higher the number, better it is, right? But if in general, if there's a company and you know the asset turnover ratio for that company is, let's say, less than 1, whether you can say it is good or bad, maybe not. You cannot directly come to a conclusion. Let's say if there's a company C, that has an asset turnover of 0.75. Okay. So is it good or bad? The answer is we don't know. Why we don't know? Because we don't know the industry. Until and unless we know the industry in which this company C operates, we can't say that. Why are we actually coming to this kind of a conclusion? We are saying this because every industry has its different kind of asset turnover ratios. So just to give you a perspective, let's say if this company C is in utilities, is a utility company, or let's say if it is an energy company, then if you look at the energy company or utility company asset turnover ratio, it's around 0.50. So this is less than 1, and all the companies in most cases will be around this number. So if this company C was a utility based company or an energy company, this would have been a much, much better ratio, right? Because this company C is generating higher ratio, higher asset turnover, higher sales per unit of assets compared to the peers, right? So that we cannot generalize, as I said, if asset turnover ratio is less than 1, it is bad. We cannot say that. Okay, we have to look at the industry. Likewise, when we say that if asset turnover ratio is greater than 1, again, we cannot come to the conclusion whether it is good or bad. We have to again look at the industry. Let's say if there is company D, okay, whose asset turnover ratio is, let's say, 1.5. Okay, so is it good or bad? Again, the same logic comes here. We don't know. Let's say if I give you a industry, if this industry is retail, then what will you say? Whether company D is doing good or not? Obviously, for you to actually know whether this is good or not, you need to know whether the retail industry asset turnover is greater than one or not. I'll just tell you what exactly that number is. It's greater than two, actually. This industry operates at a higher asset turnover ratio because they have to quickly churn out sales, per unit of assets. So the speed at which they have to churn out sales per unit of asset is much faster in retail. So it's usually greater than two on an average. And if this company D is operating in this industry, then this is not doing good, right? Because it is only 1.5. So even though asset turnover ratio was greater than one, but as a whole, if you compare to the industry, it's not doing very good. So that's how you basically interpret the asset turnover ratios. What is net fixed asset turnover ratio? Net fixed asset turnover ratio is actually a part of the ratio analysis framework, and it comes under the operating efficiency category. In our last video, we discussed about asset turnover ratios. And if you look at the net fixed asset turnover ratio, there's only a slight difference. This is the net fixed included here, right? So what was asset turnover ratio? Asset turnover ratio actually told us how the company is able to utilize its assets to generate sales. So how efficiently are they doing that? So it came into the asset turnover ratio. But the key here was that when we considered the assets of the company, in the asset turnover ratio, we included all types of assets like the current assets, which had the cash and cash equivalents, marketable securities, account receivables, inventory, etc. So the current assets was included. Now the second part is the property, plant, and equipment, that the fixed assets, that was also included, and the intangible assets like the copyrights or the trademarks, etc. That was also included as the total assets. And in addition to that, goodwill, which also forms a part of the intangible assets, was also included here in the asset turnover ratio. So all in all, we included the total assets here, right? But when we consider the net fixed assets, we say that only the tangible assets of the company should be included. And net fixed assets turnover essentially means how much amount of sales the company is able to generate from its tangible assets. Okay, so if you look at the balance sheet, we essentially are talking about the property, plant, and equipment, line item within the asset category. So these are the tangible assets to look at. Another thing to look at here is that where we consider net fixed assets depends on the industry. You cannot really literally apply this in services industry, for example, where net fixed assets is very low, as in they don't own lots of assets, right? But when you compare it with other industries like manufacturing or automobiles, they are the ones who have invested a lot in their property, plant, and equipment. So you basically consider this in manufacturing companies, automobile, energy, utilities, etc. So anything which demands high capital expenditure in its assets, those are the companies for which you can actually calculate net fixed asset turnover ratio and do a meaningful interpretation. So but you cannot do that for asset light companies. Like there are technology companies which don't invest in assets, you can't consider those. Services industry as well. So that's the key difference. Now let's come to the formula. The formula for the net fixed asset turnover will essentially remain more or less similar. In the numerator, we have the net sales, and in the denominator is there is a slight change here. Here it is the average net fixed assets. Okay, so you can assume that net fixed assets is usually the property, plant, and equipment that is found on the balance sheet. Okay, so that's how you can find out what the net fixed assets of the company are. So this is the major difference. And let us now look at the calculation of net fixed asset turnover with the help of an example. So here is the same example that I will use, which we did for the asset turnover ratio. So in this case, we found out that the asset turnover ratio for company A was 2.375 and company B was 1.56. So for a quick refresher, I'll just revise this once again for the sake of those who are looking at this video for the first time. So here we have the gross sales and the sales discount. So what we do is that in order to find the asset turnover ratio, we need the net sales numbers, right? So the net sales numbers are gross sales minus the sales discount. That comes out to be 9500. And we have been given the assets number as well. So here in order to find the average assets, we just need to add these two and divide it by 2, or you can use this average formula as well. So we found out the asset turnover ratio, and we concluded that company A is much better than company B, because on that asset turnover basis, company A is able to generate higher sales, $2.3575 per dollar of asset, right? As compared to company B, which only generates $1.56 of sales per dollar of assets. Okay, so now we will look at calculation of net fixed asset turnover, and for that we will need the net fixed assets number. So let's assume that we have this property, plant and equipment numbers for the start and the end of the year. Okay, so that's the only addition which I will do in this example. And as you will note that in the balance sheet, you will get this number PPE, property, plant and equipment, right? So let's assume that this is 2000 and this is 3000. Okay, and for company B, it was 1000 and 2000. Okay, so let's calculate the net fixed asset turnover ratio. For doing that, the formula is net sales divided by average net fixed assets, right? So how much is the average net fixed assets? The average of net fixed assets is the average of these two numbers, right? So property, plant and equipment, start and end. So we'll find the average. This comes out to be 2500 for company A, and comes out to be 1500 for company B. Net sales numbers, we already have it here, and we have the average net fixed assets here. So the calculation should be fairly simple. Net fixed asset turnover, this will be equal to net sales 9500 divided by 2500. So this comes out to be 3.8, and for company B, this comes out to be 5.2. So as you can see here, that we have a totally opposite situation to look at. On one side, the asset turnover ratio of company A was higher, and on the other side, the net fixed asset turnover ratio of company B is higher, right? In terms of interpretation, what we can say here is that company B is doing exceptionally well in order to generate sales from its fixed assets. What this is essentially could mean is that for company B, maybe a lot of assets is blocked in intangible assets, maybe goodwill or trademarks or legal rights, or maybe in current assets as well. So that's where the lot of assets are kind of blocked, and if you only consider the net fixed assets, that's where they are really doing good. So if this was an industry which was, let's say, a manufacturing setup, we would have considered and came to the conclusion that company B is doing much better as compared to company A. All right, so that's how you interpret the net fixed asset turnover ratio. What is equity turnover ratio? Equity turnover ratio is a part of the ratio analysis framework, and it comes under the operating efficiency category. In our previous videos, we learned about the asset turnover ratio and the net fixed asset turnover ratio, and equity turnover ratio is more or less very similar to these two ratios. On one side, when we considered the asset turnover ratio, we said, let's find out how much the company generates in terms of sales per dollar of its assets investments. But when we talk about equity turnover, on similar lines, we try to see how much the company is able to generate sales from its shareholders' equity. So let's say if the equity turnover is 2.0, this would mean that the company is generating $2 as the revenue from each dollar investment from the shareholders' equity. So that's how is the equity turnover actually interpreted. It's very similar to the asset turnover ratio. Let's now look at the formula for the equity turnover ratio. The formula is again very similar. Equity turnover ratio. It starts with, it's basically net sales divided by your average equity. All right. So again, net sales is different from gross sales or any other type of sales which is given on the income statement. Net sales essentially means that whatever your gross sales are and you deduct your refunds and returns, that's what is the net sales all about. And when we talk about average equity, we consider the equity which has been invested in the company, right? So from the shareholders, when during an IPO, the company comes up with lots of shares, and also the average equity we are talking about is the average of the start of the year equity and the end of the year equity. So please remember that this shareholders equity is the balance sheet item, and on the balance sheet we get the data for a specific point in time, right? So at the start of the year and the end of the year. So it's better to take an average of the two so that the calculation that we do is not skewed towards the start or the end of the year, right? Because during the year, lots of changes may happen. So if your end of the equity year data is very small compared to the start of the year, your calculations may become disproportionate. So that's why the average number of the balance sheet equity is taken here. Now, let's look at a quick calculation of this equity turnover ratio with the help of an example. So here is the data that we have. There are two companies, company A and company B, and we have been provided with some data like the gross sales numbers and the sales discount and the equity at the end of the year and the beginning of the year. All right, so let's find out the equity turnover ratio. The equity turnover ratio is net sales divided by your average equity, right? So the first step will be to find out what's the net sales number. The net sales here is gross sales minus your sales discount, right? So this will be 10,000 minus 500. So this comes out to be 9,500, and for company B, it will be 7,800. So this is the net sales amount. Average equity is the average of these two numbers. So let's find that out. Average of 4,000 and 5,000, we get this as 4,500. And for company B, this is again 4,500. All right. So the equity turnover will be 9,500 divided by 4,500. This is 2.11. And for company B, this comes out to be 1.33. So what is the interpretation? Let's say if these two companies are operating in the same industry, we can say that company A is able to generate higher sales per unit of its shareholders' investment. So because they are able to generate $2.11 of sales when they invest $1 in shareholders' equity, as compared to company B that generates only $1.73 per unit of their shareholders' equity. This seems to be fine, right? But when it comes to the interpretation of equity turnover ratios, you need to remember two things. First is that they should be from the same industry. Okay, so you cannot compare, let's say, a utility company with, let's say, a services company. So obviously, when we talk about companies which involve high capital expenditures, they have a very low equity turnover ratio. But when we look at services-oriented companies, they would have a high equity turnover ratios. So you cannot compare services company with a utilities company. That's point number one that you need to remember. Second is again very important, which means that if you look at this ratio can be easily manipulated. Now, what do I mean by easily manipulated is that, let's say if the management wants to improvise upon its equity turnover ratio? What options do they have, right? What options can they look at? Can they increase net sales? Of course not, because net sales will depend on the competition and everything else. So this cannot be done. But this will is a natural process, right? Increasing net sales. But when it comes to equity, this is the average of the equity, right? The average equity is the average of these two numbers. Now, let's say if the beginning was at 3,000, can the management do something to change the equity at the end of the year? Can they take some steps to do that? There are certain steps by which they can easily do that. They can look at buyback of equity. Now, buyback of shareholders' equity would mean that they would buy back shares either from the cash which they have on the balance sheet, or maybe they can raise debt and buy back, right? They can do that, or they can use the current cash in the bank, right? They can also use that. So let me give you a hypothetical example to elaborate on these two things. Let's say at the beginning, I'll just take this example, the same example here. I'll just copy and paste this. Company B, that's a new. All right. So let's say at the end of the year, this company B new raises debt of $2,000. Okay, and they use it to buy back this equity. All right. So if they buy back equity worth $2,000, if earlier it was 6,000, now it will become 4,000, right? So this will be equal to this minus 2,000. Okay. So the equity at the end of the year would be 4,000. Now look at the equity turnover ratio. What has happened to the equity turnover ratio? Equity turnover ratio has increased to 2.23. So what I was trying to tell you is that the management can impact the equity turnover ratio by changing the capital structure of the company. The capital structure of the company changes by raising debt, and then you go into the buyback and reduce your equity further. That can be done. All right. So you have to always go back and look at what and why these things are happening. And if you want to compare the two companies, you should always know the history of their buybacks and what has happened in the shareholders' equity structure altogether in the previous periods too. All right. So with this, we understand now what equity turnover ratio is, its calculations and interpretations.
I hope you found this video to be useful. Please do like and share. And if you have any feedback or want to suggest a topic for any future videos, then you may do so by writing about it in the comments section. Also, we come up with interesting videos on finance and accounting topics regularly. So if you haven't subscribed to our channel yet, then please do so by clicking on the subscribe button below so that you can get the notification about our latest videos as soon as we release one. Thank you for watching. Have a nice day.